and I'm the founder. So I'm the founder and CEO of Zeneta, and I'm just going to give it another few more seconds for people to log in. While we're waiting, just want to give a couple of housekeeping items. I'll keep my eyes on the chat as best as I can. Feel free to post questions as we go. I'll post a bit at the end as well and leave a little bit of time for Q&As. But I'll start my screen sharing now just to make sure that everything is working perfectly fine. Let's see. And then I'm going to check if I can keep the question panel open as well. Let's see. Yeah, that works. All right. So I think that's it. I'm going to get started. So I'm here today to talk about the state of the container freight market, primarily from a rate point of view. Really happy to be here and appreciate the invitation coming from Container Exchange to get an opportunity to present. The agenda that I thought I'd go through today with you would be the following. First, to look at the market from an historical perspective, really go 50 plus years back in time to understand sort of how could we end up here, and then look at where are we actually today, and then raising the question, is this just another cycle? Have we seen this before? So those are the three main things I would like to cover. And I'm going to just kick it off with this. And this is not an actual sort of chart. It's more of like an illustration showing the value of global exports over time. And it's very clear here from the introduction of the containers, the market really literally exploded, right? So global trade accelerated when the container was introduced. And I'm sure most people are very well aware of this. But what has happened in parallel is that box rates have just gradually trended downwards. So it's become cheaper and cheaper to transport container boxes from one side of the world to another side. And that's all fine. This equation of increased global trade and declining rates makes sense as long as you continue to chase economies of scale. And if you look at this within container shipping, it's absolutely flabbergasting to see the development. If you see back in 1968, there was a 1,530 TEU vessel there. And you can see now in 2020, this is already outdated. But you can see the biggest vessel then at 23,964 TEUs. This portrays absolutely fantastic sort of development, and together with the two charts that we reviewed before, it shows that it's completely possible to reduce the unit cost because you have economies in scale, and it's cheaper and cheaper per box to move it as well. And if you look at that overall, it's a 1,200% increase since 1968. Whether you look at the max TEU capacity or the TEU size of new builds or average TEU capacity, it's all growing aggressively for a long period of time. Now, what doesn't work so well, and what really is a big problem with this picture, is when you have shocks in the economy. And this one is just, illustrating the one back in 2009, right? And the equation with cheaper and cheaper box rates and growing volumes of cargo is fine until you hit these periods. And you can see this from this chart. This is showing the best-in-class container shipping lines and their EBIT margins in percentage. It's just a period here from 2007 to 2015. And I want to focus on this period because it was prolonged until 2020 as well. And this is a period where hardly any of the shipping lines made any money. And in 2016, Hanjin went belly up, as we are all aware of. But you can see here from the worst in class and the peer group average that hardly anyone made any substantial, meaningful amounts of money. And this means, again, that there's no profitability in the business. It's not a business and an industry that attracts shareholders and more capital to be invested into the infrastructure. And what typically happens in those kind of industries is consolidation. M&As consolidation. And look at this timeline here. It's going 25, almost 30 years back, and you can see that if we go back to the early 2000s, the top 5 market shares of the shipping lines collectively was 27%. And then you had these mergers, as you can see here, that sort of lifted out to 31. Then around 2006, 2008, you had another round of M&As, and you can see that the top 5 at that point moved from 36 to 43. And then in this sort of final wave, which is very close to where we are now, you will see that if you look at the top 5 market share of long haul trades, it's so condensed that the top 5 collectively has 66%, and I believe the number has just reached plus 70% as well. And this means that, you know, there's fewer and fewer options for the customers to choose between when they settle with their new suppliers. In fact, this picture is even worse within liner shipping, because on top of this, the carriers have grouped into 3 alliances, as you can see here, 2M, Ocean Alliance, and the Alliance, which arguably, you know, makes a point that there isn't 10 plus whatever carriers on a global scale. There's 3 alliances to choose from. And I think this is a very worrying sign and development for an industry. And I just wanted to highlight that it's very natural because of the rough conditions. And then I'm going to link this to sort of where we are today. But to understand where we are today, I want to go like through a period of sort of like a period where we also cover the COVID period, right? Because what really happened in the beginning of 2020 is, and this is not an exhaustive list, this is only to portray a picture of what we've gone through, right? Because you had that initial COVID shock when China shut down, then Europe and partially US, and then you had this supply shock where, you know, production decreased and consumption halted, and all these boxes piled up outside of the shippers' warehouses. I'm not sure if you remember that, but there was thousands and tens of thousands of container boxes piling up because people stopped buying goods because they feared what was coming in terms of unemployment and so forth. And as a response to that, the shipping lines blanked a lot of sailings. And you can see here that Asia, Europe was down 36%, and Trans-Pacific eastbound, they removed 28% of the capacity on those trades. And then in Q2, we slowly saw that consumption sort of came back. And as we were, majority of the world was sort of in lockdown, the spending shifted from away from travel and services into physical goods. And that made that volumes grow. And at that point, the carriers had to reintroduce capacity, but it was already too late. The capacity already got strained, and rates started to rise at that point in time already. Now, by the time we got to Q3 2020, they had, you know, deployed far more capacity back in the market, but at that point, rates were really soaring, and equipment was a big problem. It was difficult to get hold of it, and the majority of our customer base, which is shippers, they really at that point struggled. Going into Q4, we reached record high ocean freight rates. It was an all-time sort of seller's market, and they started playing the market by changing the MQCs, so the minimum quantity commitment that they had with their customers, in order to push more cargo on an even higher short-term rate. And I'll show this data in a little bit. In fact, this was a notable period because it's the first time I've seen that carriers didn't want to fill empty boxes going out from the US back to Far East, because the profitability on the front haul was so significant that they just wanted to rush the empty boxes back rather than getting a few $100s for an export box, which I had never seen at that point. And then, you know, you fast forward into the first half of this year, and it's been a sort of very long list of difficult conditions, and whether it's congestions, whether it's port strikes, Ever Given getting stuck in the Suez Canal, or Yantian or Ningbo closing down, or Shanghai airport. It's been a very long list of disruptions that has just continued on. And this portrays 6 quarters of difficult market conditions, right? And that sort of takes us to where we are today, as of September 2021. And I got to say that the market is absolutely crazy. It really is. I've never seen anything like it, and we keep on saying that over and over again. So let me dive into some details. And before I do that, I just want to make it clear sort of where does our intel come from, and why can I say something about the market? And the reason for that is that we work together with these big global corporations across the world on all continents that feeds in their ocean freight rates into the Xeneta platform. And we work with 3 of the top 5 shipping lines, 7 of the top 10 global forwarders, and they all submit data into the platform, not the carriers, but the 2 other parties, the shippers and the forwarders. And this is the data sets that I'm going to lean on to explain where is the market today. So then first, from just sort of outlining the highlights of where we are as per today, I would point out that the markets are still on an upward trending basis, going up, both for the short and long-term market. We'll see how much soon. There's still all these disruptions coming from prolonged transit times, rollovers, and congestions. In fact, there's a very strong appetite to look at alternative modes as to ocean freight, meaning air freight, rail, road. I've seen extreme cases where it's been road freight from China to Europe. So this market is really wreaking havoc for a lot of the players involved. And then this point about the carriers' profitability and even the forwarders' profitabilities, but the carriers in particular, where we've seen now a lot of new builds being ordered. And I want to link this to what I started with, because I started sort of outlining that the industry has struggled for decades, and the customer side, the shippers, and even the consumers has sort of benefited from that. But on the flip side of it, it's been limited resources to invest in the infrastructure. And now finally, you see an opportunity for the shippers to invest in the infrastructure that's needed, but it will take years for that to be deployed in the market. And to be a bit of a devil's advocate here, I want to argue that the shippers have sort of caused a little bit of this situation themselves by continuously pushing their suppliers to cheaper and cheaper rates. Now, one final thing I want to flag as of where the market is per today is that we see these COVID-related incidents just coming back all the time, whether it's Yantian or Ningbo, as we've seen, or Shanghai, and it's very hard to predict, but it seems that this might be lasting quite a bit longer than most experts anticipated. So then if we go to the actual market and look at hard numbers, I'm going to see if I can share another screen here. Let me see. Let's look at some numbers and to really understand what has happened in the market. All right, so what I want to start off with is the actual price development. So what I've selected here is a few big global trades, right? So going out of China to North Europe main, China main to South America East Coast, main ports, China main to Australia and New Zealand, China main to US East Coast, West Coast, and then North Europe main to US East Coast main. We're looking at now a 1 year time horizon for these trades. And I just want to show and highlight what's happened over the last 12 months. In the overview, sort of when we looked at when COVID started, it's been a more dramatic increase, and I'm going to show you one example of that as well. But if you here take a look at what has happened on the short-term market in orange, it's sitting currently on as an average value of 13,300. It's up 534% in 12 months, even more on an 18-month scale. The long-term market is now at 5,225, up 295% over a 1 year period. right? As you move your eyes down, you will see that all of these trades are significantly up. And I want you to think about companies spending 10, 100, hundreds of millions of US dollars on ocean freight before COVID hit, and then the budget increases and the increased spend that they're currently facing coming from this market development. I also want you to notice how much of a difference it is between the short-term market and the long-term market. And this gives a few different, very interesting nuggets, meaning on the long-term market, you'll primarily find the big volume players. And on the short-term market, you'll find smaller volume players, which means that everybody's paying more, but it's way tougher to be a small importer exporter than it is to be a big volume player. So this has really given a competitive edge to the bigger players. Then I want to move into schedule reliability and just take Far East main ports here to North European main ports as an example. We'll see that the current or June-July schedule reliability was at 22%, down 68% over the last year. And you can see the trend here. And if I expand this view, you can see that it's 68% down from a year ago. And you can see that the carriers are really struggling, but some carriers are performing far better, like Hamburg Süd and Maersk Line and MSC, than other carriers. So it's a big delta between the top performers and the worst performers, but overall, they're all significantly down. So I'm basically saying two things. The market is incredibly expensive, and the product and the service you're buying in the market or the shippers are buying is all-time poor. It's the weakest product they've bought. So it's a bit bizarre and counterintuitive to see this sort of development. Now, let me see if I can then move back to my presentation and see if I can find a deep dive example here. Let's see. All right, so you should see my presentation again here. So let me move us a little bit forward with on this. So stay with me. All right, here we go. So if I give you one example of this, where we look at the period from May 2020, April, May, in this graph, and let me be clear here, what we're looking at is Far East main ports to North European main ports. We're looking at the price development for a 40-foot standard dry box. And then we're looking at rates for the short-term market in yellow and the long-term market in blue. Right, so you can see the dramatic increase that has happened over the, what is this, approximately slightly less than 18 months, right? And the increase on the short-term market here is a staggering 825%. Think about that. Faced with those kind of increases, and this is the average, meaning there are companies paying 20,000, right? So if you think about this increase, and then think about the cargo value inside a box, the relative portion of the cargo value is the increase is dramatic, so that some importers and exporters can't even move their products with this, as the margins are fully eroded. Right? This also gives you a very strong indication of what is possible for the shipping lines in terms of profitability, but I'll get back to that. I also want to flag this point here about the fact that the long-term players, as the gap has sort of increased between the short-term market and the long-term market, has made them more exposed to risk. And just think about this, from the carriers loading a vessel in, let's say, Shanghai, looking at the different boxes at the port, you will see that the yield and the profits they can make by picking up some of these short-term agreements, that's very attractive for them relative to what they have on the long-term market. That's another struggle that the shipper has on this corridor. So let me with this sort of development in mind, let me go to a little bit of a study we did. So what we did as a company is that we collect all the rates, but then we also look at the profitability of the carriers and the forwarders that are stock listed, right? And it's interesting for us to look at that to understand how our data maps up, stacks up against it, right? And this, I just want to flag this chart here because you can see that the Q2 financial reports are out. The Q3 financial reports are not out yet, but what you can see from our data is that there's still substantial room for the carriers and the forwarders to report even more and greater and better profitability numbers than they've done so far in this pandemic. So I think it was Hotbug that announced, or it was clear from their numbers that they had made more money in the last 6 months than they had in the previous 10 years combined. And you can see from this development here that the carrier profit margins have, EBIT margins have grown significantly from Q1 2020 all the way to Q2 2021. But you can see from the lines, which is our rates, you can see that there's still much more for them to report come Q3. So it's going to be interesting to follow. I think it's a good time to be a shipping line, to be honest. All right, so on that note, let me also flag some additional interesting market observations that we see these days. It's the market spread. So back in the days, let's say a normal market spread were around $2,000 from high to low. Now we see spreads ranging from like 5 to 25,000 on the Trans-Pacific, as an example. That means that some companies are paying $20,000 more than the next one. That also makes this market very difficult to understand for the customer side in particular. There's actually auction-like situations, meaning forwarders will almost bid their business out. So, you know, one shipper, they agree a price with the shipper, then another desperate shipper comes along and they will entertain a higher bid and cancel the booking from another customer. It's absolutely bizarre. There's so much tension between the carrier and forwarder side, with carriers going out with their ambitions about vertical integration, stepping into the turf of the freight forwarders and eating a piece of the pie on that side. And yeah, that's that point. And this time, this is nothing new. We've seen that in the industry for that appetite they've had for decades, but now they come at this from a position of strength with a lot of financial muscles. So it's going to be interesting to see how that develops. Then we see that carriers are now currently pushing for multi-year deals. Obviously, they're super satisfied with the high level for the rates, also the long-term rates, right? So they're willing to lock in longer-term rates, 2-year, 3-year deals, as that would be a very nice way for them to secure long-term profitability. And on the flip side of that, shippers are pushing hard to find the relevant indices to regulate these agreements so that they don't get locked in for too long on very elevated rates. Then we've seen and still see a ripple effect where outbound Asia was sort of the first trades to really move up in price when COVID hit. And now, in order to attract boxes and capacity, transatlantic trades are skyrocketing. So it's not only let's say the main trades of the world, but also Europe to South America and so forth are really moving up. Then another thing we see happening in the market is, you know, if you secure an ocean freight rate, but you also negotiate haulage or on carriage, pre-carriage, or warehouse services even, then you can achieve more favorable rates. And this is related to the strategy for some of the carriers to push for this vertical integration that I mentioned. Now, I did flag this already, but think about the fact that these customers are buying a very weak product at a very elevated price. I want to wrap this up by giving you an example of just how bad that price spread is that I mentioned, that somebody's paying far less than others. And you can see from this chart, this is just a few of the prices plotted. It's from the same shipping line towards the same forwarders and so forth. So very sort of comparable data set over time, where you can see that the spread that they had back in the days was very narrow, and that the spread that they operate with now in more recent times are just exploded. And this is dynamics and different markets as to where different customers find themselves that simply did not exist as little as 6 months ago. So that leads me to the final question. Is this just another cycle? Is this, going to pass and be another spike and then we go down? So I have a few, I think, very interesting nuggets here. Let's look at the previous crisis, right? The one that I mentioned in my intro, around 2009, 2008. So back then you had an order book that was full. This time around, there's no immediate deliverables, but there are orders being placed, a lot of them, right? But that's the difference. Now, the carrier's financials back in 2008 was very, very strained. And in 16, Hanjin, as I mentioned, went belly up. Then this year, it's completely different. We went through this already. So if we move then and look at the demand side, back in 2008, the outlook was very weak. This time around, we struggled to see relief on the immediate horizon. So on the capacity side, overcapacity, full utilization this time around. Equipment side, there was a surplus of that. Now it's limited availability and a lot of repositioning issues due to these continued sort of shocks from COVID. The rates were historically low back in 2008. And, as I mentioned, they're still rising now. Then charter rates, same story there, really low back in the days, historically high now. That moves me a little bit more to what we're facing. Well, there's these events just on the horizon. This comes on top of whatever COVID brings, right? Then there's an order book to fleet ratio that I also want to flag that is very different back from 2007 and 8 and 9 to what we have now. Then all capacity is almost in play. There's nothing that we can, put in anymore. Like here you see a chart that outlines the capacity in Q2 2020, which dropped with 9% point down to 1% in Q2 2021. So more or less all capacity at play. And then the gloomy outlook is that IHS market is forecasting demand to sort of outstrip capacity growth over the next couple of years as well, with the percentage figures illustrated here, 4.9 versus 3.2 in 2022 and 3.1 versus 2.1% in 2023. I guess this sums up a very sort of gloomy picture. And I think this leaves us in a state where, it clearly is different market conditions in this cycle. And obviously the carriers have learned to adapt and adjust their capacity in order to not destroy their own markets. And they can see that they can make a profit from that. And then you have the market, the circumstances of COVID and everything from that, as well as, port strikes and things like that, and a strained infrastructure. And I think that's an incredibly important point. It's not only the vessels and the boxes and so forth, but it's also the ports and the hinterland connections that are strained. And we believe that the market will definitely soften at some point, but a new normal should be expected. Yeah, and I think that sums up a little bit the three topics that I said I would cover for today. Then there's a couple of questions that sort of come in here. The first question is about long-term contracts with carriers, and there was a session with Lars Jensen earlier today talking about an increase in that. And I want to flag, then the audience is asking me what we see at Zenera. I want to flag that Maersk Line went out in their last financial report and actually said that they moved from 43 to 60% of their business secured on long-term rates. And we see an increased appetite to provide long-term rates to the shippers. The struggle is that the shippers are very, very uncertain as to what's going to happen with the market, and nobody really knows, right? So the conundrum here is to find the right mechanisms to secure those long-term agreements. And it's very obvious that there's an increased amount of long-term contracts, but they're still playing with the MQC of the shippers, meaning you might agree on paying, let's say, 5,000 on a certain trade with 100 boxes a week. But if you deliver 80 boxes next week, the MQC will be adjusted to 80, irrespective of whether you deliver 120 the following week again. So that delta of 40 that you over the 2-week period collectively could have just hit your MQC, you will still be penalized by paying more of a short-term market rate on those 40. So I want to stress the fact that even though they've secured way more volumes on long-term contracts, they will still play and push as much of the volume from the customers at a premium price. Then there's another question here of very small new carriers or shippers directly chartering have any real effect on rates of large carriers. So I think the question here is what we've seen in media lately about what is it, Home Depot, IKEA, and so forth, chartering and acquiring their own containers and chartering vessels. It's a topic we debated and discussed with a few of our clients as well, and I got to be cautious about confidential information there as well. But in general, it doesn't solve the infrastructure problems necessarily, and there are middlemen involved as far as we are aware, which means that it's not the shippers directly taking responsibility for this full, so, meaning they're not running the full operations of these vessels and taking completely care of it, but it's agreements with middlemen to try and secure more capacity for them. So what I believe is going to sort of come up from the situation we're currently in is new entrants. If the market stays elevated, new entrants will appear in the market, and it already has. There's a few Chinese players already, especially in particular on the Trans-Pacific eastbound. And then if the market drops back down a little bit, we can see another wave of consolidations as the financial muscles for the big players are massively improved. Then there's another question on how we measure schedule reliability. As of when do you fix the expected? So there's all the reliability data actually comes directly from a Danish company called Sea Intelligence, which we have a partnership with, and they have a set methodology of how they operate with this. And I'd love to follow up separately on that note, as I don't have the detailed information on that, but they have a very renowned methodology of capturing and measuring that data, and is widely known as the best source for this type of data. I'm gonna pause a little bit longer to see if there's any additional questions. All right. Otherwise, I think I want to thank you for joining and for listening in. Really appreciate it. If there's any questions at a later stage, don't be shy. Shoot me an email, ping me on LinkedIn, and I'll follow up. Thank you.